Something just changed in XRP that matters more than it looks. The market didn't react because a law suddenly passed. It reacted because the odds of regulatory clarity may have shifted. And that's the kind of change institutions monitor long before retail investors do. Today, we'll examine what actually changed in Washington, why XRP outperformed much of the crypto market, what the data is really saying, and whether this marks the beginning of a structural shift or simply another short-lived rally. For years, XRP has occupied one of the most uncertain positions in the cryptocurrency market. It survived lawsuits, exchange delistings, and years of debate over whether it should be regulated as a security or something entirely different. That uncertainty didn't just affect investors. It affected banks, payment companies, asset managers, and every institution considering whether XRP could play a role in future financial infrastructure. Now, reports indicate that lawmakers have made progress on one of the key issues holding up the proposed CLARITY Act. The legislation has not become law, but political landscape appears to be shifting. And in financial markets, changing expectations often matter before final outcomes arrive. That's exactly why XRP immediately drew attention. The real question isn't why the price moved. The real question is whether the regulatory foundation beneath the market is beginning to change. See, when people think about cryptocurrencies, they usually think about prices, charts, volatility, daily gains and losses. But that's not how large financial institutions look at the market. Banks don't simply ask whether an asset may increase in value. They ask whether regulators have created enough certainty for them to build products around it. Asset managers don't focus only on momentum. They focus on legal risk. Payment companies don't just evaluate technology. They evaluate compliance. For institutions handling billions of dollars, uncertainty can be far more expensive than volatility. That helps explain why developments in Washington matter so much. According to recent reports, lawmakers have made progress on one of the key issues that have been slowing movement on the proposed CLARITY Act. The sticking point involved ethics, provisions related to how members of Congress could manage personal cryptocurrency holdings. While that may sound like a relatively small procedural issue, legislation often depends on resolving exactly these kinds of disagreements. Importantly, the bill has not become law. It still must move through the remaining legislative processes and additional negotiations where amendments remain possible. But markets rarely wait for final signatures. Markets react to changing expectations. And for many investors, the probability that the United States could move towards a clearer regulatory framework appears to have increased. That shift in expectations was enough to push XRP ahead of several other major cryptocurrencies following the news. But why XRP? Why not Bitcoin? Why not Ethereum? The answer lies in something much deeper than price action. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. Unlike many other digital assets, XRP has spent years at the center of one of the most important legal battles in crypto history. The lawsuit between Ripple and the SEC became far more than a dispute involving one company. It evolved into a broader debate about how digital assets should be regulated in the United States. The outcome affected exchanges, developers, institutional investors, and perhaps most importantly, confidence. Let that sink in. Although Ripple achieved significant legal victories in court decisions and legislation serve different purposes. A court ruling resolves a specific legal dispute. Legislation carries rules that apply across an entire system. That's an important distinction. Let this sink in. See, imagine trying to build a global payment network while everyone and every potential customer asks the same question. What happens if the rules change next year? No business likes operating under uncertainty. Banks certainly don't. Neither do multinational corporations. If lawmakers ultimately establish clearer rules governing digital assets, institutions may find it easier to evaluate opportunities that previously appeared too uncertain. That doesn't guarantee widespread adoption. It doesn't guarantee higher prices, but it changes the conversation. Instead of debating whether a regulatory framework might exist someday, investors begin evaluating what that framework could actually mean. That's a very different discussion. And markets often begin pricing in those possibilities long before the process is complete. Now, this is what most people miss. Financial markets don't move only because of facts. They move because expectations change. When expectations improve, Capital begins looking ahead, sometimes months ahead, sometimes years. History offers a powerful reminder that confidence often grows when rules become clearer. One of the best examples came during the Great Depression. In 1933, following widespread bank failures, the United States created the Federal Deposit Insurance Corporation, better known as the FDIC. Before deposit insurance existed, fear spread quickly. If people believed the bank might fail, they rushed to withdraw their money. Those withdrawals can become the very reason banks collapse. The creation of deposit insurance didn't instantly solve every economic problem, but it changed confidence. People gradually trusted the banking system more because they understood the rules protecting their deposits. Confidence returned slowly. Investment followed. Economic activity recovered over time. The lesson isn't that cryptocurrency today is identical to banking in the 1930s. The situations are completely different. The lesson is that financial systems become stronger when participants understand the framework governing them. Clear rules reduce uncertainty. Reduced uncertainty encourages participation. Participation creates liquidity. Liquidity attracts even more participants. That pattern has repeated throughout financial history in many different forms. It's very important. This brings us back to XRP denoising. Supporters argue that clear legislation could reduce one of the biggest barriers preventing broader institutional participation. Critics respond that regulation alone doesn't guarantee adoption and that technology, competition, and market demand remain equally important. Both perspectives deserve consideration. That's why experienced investors focus on evidence rather than emotion. You've got to let that sink in. That's massive. They ask what has actually changed, what remains uncertain, and what developments still need to happen before long-term conclusions can reasonably be drawn. Those are the questions driving today's market. Not simply whether XRP rolls on a particular day, but whether the foundation beneath the market is beginning to shift because prices are reacting, but the system itself may be evolving. Another reason this story has captured so much attention is the difference between how retail investors and institutions approach uncertainty. Retail investors often respond to headlines almost immediately. Institutions rarely do. Large financial firms operate through investment committees, legal departments, compliance reviews, and extensive risk analysis. Every new regulation is examined. Every legal development is evaluated. Every potential investment must satisfy internal standards that individual investors rarely need to consider. That's why regulatory clarity can matter just as much as technology and technological innovation. A faster blockchain is valuable. A more efficient payment system is valuable. But if compliance departments cannot approve participation, adoption remains limited regardless of the technology. This is why many analysts believe the debate surrounding digital asset regulation extends far beyond XRP itself. The outcome could influence how banks, payment providers, investment firms, and financial institutions evaluate an entire sector. Whether the proposed legislation ultimately passes in its current form changes significantly or faces further delays. One thing has become increasingly clear: the conversation is no longer just focused on whether cryptocurrencies should only exist. It's increasingly focused on how they should fit within the financial system. And that may prove to be one of the most important shifts the industry has seen since digital assets first entered the global conversation. If there's one lesson financial markets have taught investors over decades, it's this: headlines may spark a rally, but only sustained conviction can keep it alive. That's why experienced market participants don't stop at the news. They look beneath the surface. They study capital flows, on-chain activity, technical structure, and the behavior of investors who typically move long before the broader market catches on. The recent excitement surrounding XRP is no exception. While political developments have fueled optimism, traders are now asking a much more important question. Is the market confirming the narrative, or is the narrative running ahead of the market? One of the first places analysts turn is the price chart. Not because charts can predict the future, but because they can reveal how buyers and sellers are responding to new information. Throughout recent trading, XRP has managed to defend several important support areas after weeks of consolidation. Rather than collapsing after each rally attempt, buyers repeatedly stepped in, suggesting demand remained present even as uncertainty lingered. Many technical analysts are watching the area around $1.13 particularly closely. The reasoning is straightforward. Markets will often behave differently once formal resistance becomes support. If buyers continue defending that level over multiple trading sessions, some analysts believe it would strengthen the argument that the recent move reflects genuine momentum after the short-lived reaction to headlines. On the other hand, If prices fall decisively below that area, the breakout thesis becomes less convincing. In that case, attention should shift back towards lower support zones, reminding investors that markets rarely move in a straight line. This isn't about predicting certainty. It's about understanding probabilities. Professional traders rarely think in absolutes. They evaluate scenarios. If one condition develops, they prepare for one outcome. If another develops, they adjust accordingly. That disciplined approach often separates investing from speculation. Now, here's where the conversation becomes even more interesting. Price is only one piece of this puzzle, ladies and gentlemen. Another area attracting attention is blockchain data. Unlike traditional financial markets, many cryptocurrency networks allow analysts to observe wallet activity directly on public ledgers. Although wallet identities are usually anonymous, changes in holding patterns can still provide valuable insight into market behavior. Recent reports suggest that larger XRP wallets have continued accumulating while many small investors remain cautious. That difference matters. Retail investors often react emotionally. Large investors typically build positions over extended periods. They rarely purchase everything in one day. Instead, they accumulate gradually while liquidity is available. Of course, accumulation alone doesn't guarantee future appreciation. Large holders can change their minds. Market conditions can shift. Unexpected events can alter sentiment almost overnight. Still, many institutional analysts consider sustained accumulation worth monitoring because it may reflect long-term conviction rather than short-term excitement. You've got to have this Gucci conviction here, ladies and gentlemen. Perhaps even more interesting is the contrast between institutional behavior and retail psychology. Many individual investors remember XRP's dramatic swings over the past several years. Some experience sharp declines after buying during periods of intense optimism. That history naturally creates caution. Institutions, however, often evaluate entirely different factors. They examine legal developments, infrastructure growth, liquidity, settlement efficiency, counterparty risk, and potential future demand. Those differences help explain why institutional positioning and retail sentiment sometimes moves in opposite directions. See, beyond trading activity, another story has been quietly unfolding. The XRP Ledger itself continues expanding. While headlines often focus exclusively on price, infrastructure growth can be equally important over the long term. The network has surpassed millions of funded accounts, reflecting continued participation across its ecosystem. Developers continue building applications. Payment technology continues evolving. And Ripple has continued working with financial institutions exploring faster methods of moving value across borders. Cross-border payments remain one of the largest efficiencies in global finance. Traditional international transfers can involve multiple intermediaries, settlement delays, currency conversions, and additional costs. Supporters of XRP argue that blockchain-based settlement could reduce some of those inefficiencies. Critics point out that adoption depends on far more than technology alone: regulatory approval, commercial demand, integration costs, competition from existing patent and payment systems. All of these factors influence whether new technology achieves widespread use. That's why many observers separate utility from price. A useful network doesn't automatically create a rising asset price. Likewise, a rising asset price doesn't automatically prove widespread utility. Over time, however, investors often look for situations where technology and technological progress and regulatory progress begin reinforcing one another. That possibility is one reason why XRP continues attracting attention despite years of uncertainty. See, history provides another fascinating perspective, ladies and gentlemen. During the Industrial Revolution, the expansion of railroad networks transformed economies around the world. At first, many investors focused almost entirely on railway company stock prices. Speculation became widespread. Some fortunes were made, others disappeared. But the truly lasting impact wasn't the daily movement of railway shares. It was the infrastructure itself. Railways permanently changed how goods moved. They connected cities, reduced transportation costs, expanded trade, and reshaped economic activity for generations. The comparison isn't meant to suggest blockchain technology will follow the same exact path. History never repeats itself perfectly, but it often rhymes. Just as railways created new financial opportunities by improving infrastructure, many believe blockchain networks could create opportunities by making certain forms of value transfer faster, more transparent, and more efficient. See, whether XRP becomes a major part of the future remains uncertain. Competition across digital assets remains intense. Technology continues evolving rapidly. Governments worldwide are still refining regulatory approaches. Yet one thing is becoming increasingly difficult to ignore. The discussion has evolved beyond speculation alone. It now includes infrastructure, compliance, institutional participation, and the broader architecture of tomorrow's financial system. And for many investors, that's a much more significant conversation than today's price movement alone. The biggest mistake, ladies and gentlemen, investors can make is assuming that one positive headline changes everything overnight. Financial markets rarely work that way. Major shifts usually unfold in stages. There are breakthroughs. There are setbacks. There are periods of excitement followed by stretches of disappointment. And somewhere in between, the long-term trend begins to reveal itself. That is why the current conversation surrounding XRP is so important. It is no longer centered solely on price. It is centered on whether the regulatory environment itself is beginning to evolve. Even with growing optimism, several risks remain firmly on the table. The proposed legislation will still complete the legislative process for upcoming law. Lawmakers could introduce amendments that significantly change its final form. Political priorities can shift quickly. Unexpected events may delay votes. Negotiations that appear settled can reopen with little warning. Markets understand this. That's why experienced investors avoid treating potential outcomes as guaranteed outcomes. Instead, they focus on probability. If regulatory clarity continues improving, institutional participation could become easier over time. The process slows or becomes more restrictive. Markets may need to reassess expectations. See, neither scenario should surprise investors. Volatility has always been part of emerging technologies. The important distinction is separating temporary market reactions from structural developments. A single trading session rarely defines a long-term trend. Changes in regulation, infrastructure, and institutional behavior often carry much greater significance than any one day's price action. That is why so many analysts continue watching Washington just as closely as they watch the charts. There's another reason this moment feels different, ladies and gentlemen. This is important. The conversation surrounding digital assets has matured. Only a few years ago, much of the debate focused on whether cryptocurrency had any legitimate use at all. Today, many governments are asking a different question. How should digital assets be regulated? How can innovation be encouraged while protecting consumers? How should traditional finance and blockchain technology coexist? Those questions represent progress in themselves. Whether one supports cryptocurrencies or remains skeptical, the discussion has shifted from existence to integration. That change may prove more important than any individual rally, because financial history suggests that once governments begin designing long-term frameworks, industries often move into an entirely new phase of development. Exactly how that price and process unfolds remains uncertain. Different countries continue adopting different approaches. Some embrace innovation quickly. Others move cautiously. The United States now finds itself at a pivotal point in the global conversation. Think about a lighthouse standing alone on a rocky coastline. The lighthouse doesn't calm the ocean. It doesn't remove the waves. It doesn't eliminate the storms. What it does is provide its clarity. Ships navigating dangerous waters still face risk, but they now have a clear understanding of where those risks exist. Regulation can function in a similar way. Clear rules don't guarantee success. They don't guarantee profits. They don't eliminate competition and market downturns. What they often provide is visibility. Investors understand the framework. Businesses understand the expectation. Institutions understand the compliance requirements. That visibility can influence decisions involving billions of dollars. See, for years, uncertainty has been one of the defining characteristics of the digital asset industry. That uncertainty gradually begins to decline. The implications could extend far beyond XRP. It could influence how capital flows into blockchain technology across the entire financial sector. None of this means investors should ignore risk. Markets remain unpredictable. Competition among blockchain networks continues to accelerate. Central bank digital currency stablecoins and evolving payment technologies are all competing for attention in the years coming. Success will depend on far more than legislation alone. Technology must continue improving. Adoption must continue improving. Real-world demand justify long-term investment. Let that sink in. That's very important. Those fundamentals matter every bit as much as political developments. That is why disciplined investors continue evaluating evidence rather than chasing narratives. They watch legislation. They study adoption. They monitor institutional participation. And they remain willing to adjust their views on new information emerges as well. See, whether you're optimistic about XRP or remain skeptical, one fact is becoming increasingly difficult to ignore. The cryptocurrency industry is entering a new chapter. The conversation is becoming less about speculation, more about structure. Less about hype and more about regulation. Less about possibility and more about implementation. That transition won't happen overnight. There will be disagreements. There will be delays. There will almost certainly be periods when markets become impatient. But throughout financial history, lasting transformations have rarely followed a straight path. They've advanced through gradual progress, policy decisions, and technology improvements and growing confidence. See, the digital asset market may now be approaching one of those defining moments. Only time will reveal how significant it ultimately becomes. But one thing is certain, the decisions being made today could shape the financial landscape for years to come. If you've enjoyed this deep dive and want more analysis that looks beyond the headlines into bigger economic picture, make sure to subscribe to the channel. Leave a like, share your thoughts in the comments below. Do you believe regulatory clarity could become the catalyst that finally unlocks the next phase of institutional crypto adoption? Or do you think the market is getting ahead of itself? I'd love to hear your perspective. Thank you for watching. I'll see you in the next video. Hope everyone's having a blessed day. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Membership videos are going to begin tomorrow. A lot happening here right now, ladies and gentlemen. Time of this recording, oil's at around $92.35. See, we've been rewarded for what we were positioning for. And that's the best part of this game. A lot of things have changed. You saw gold take it on the chin. Look where the yields on the treasury. It's ridiculous at 7%. Ladies and gentlemen, members of the Crypto Public Desk Monthly, Patreon, took advantage of major profits in trading a lot of different investments during the first round of this. Round two is going to be even better. We can see some phenomenal things. If you want to learn how to trade and you want to take advantage of what's going to happen, do come and join over 620 active traders and investors. But we were rewarded with our coal, with oil, gold. We've been sellers into this. I have been saying on this channel day in, day out that it's about the dollar. See, the inflation story is this. If crude moves higher, you will hear that blah, 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 high interest rate, blah, 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 blah. No one's raising interest rates, but that will cause inflation. If that happens and the dollar strengthens, gold takes it on the chin, silver takes it on the chin, okay? Gold cracked a major level. Where it is, it's heading lower right now. This little short-term coming rally is over, okay? Gold is going to go lower. Silver is going to go lower. We've been selling gold into all these rallies because these rallies were fake. Part of being a financial mercenary is taking risks, and you risk your reputation every day. That's why family offices and sovereigns retain us. But ladies and gentlemen, during the first Freak Show ME event, members of Crypto Public Desk Monthly saw gains between 50 to 150% in their portfolios in equity trading, energy trading, metal trading, crypto trading. This is round two. See, volatility is the long-term trader's friend. I say this all the time. I got this on my wall here in Latin, on the other side of my office over there. Latin. Volatility is the long-term trader's friend. It allows us to accumulate things at a discount while the rest of the market is going off a cliff. See, being a financial mercenary, we love the chaos. I told you what the patterns are. I've been going over this every Zoom call and in every rant of these videos. So if you go back to every video in front of this, I've been talking that we were waiting for hostilities. The Houthis entered. Crude oil went higher. Crude oil is going to go higher because there's going to be more fighting. Crude oil goes higher. The DXY goes higher. Metals go lower. 10 yields rise. This is what's happening right now, ladies and gentlemen. Understanding the pattern is all that matters. Everybody in the Zoom call on Sundays must be sitting there saying, you have a front row seat of what's happening and why. The ability now is, do you want to take advantage of this? We have plays that are just murdering it because of understanding the death by 1,000 headlines, death by 1,000 tweets. There's going to be massive moves in oil, massive moves in metals. If you want to take advantage of what's coming, come and join the Crypto Public Desk Monthly, ladies and gentlemen, and enjoy the returns that the chaos that is happening happens. Again, the gains in the Crypto Public Desk Monthly portfolio were triple digits during the first crazy portion of this conflict. The next portion is going to be even better because we're dialed in. We know what's happening and why. All it takes in this game is to be positioned before most people. That's it. And if you're here watching and listening, your position. None of this is financial advice. This is just my own opinion. I don't take any capacity. But you got to see this. Now that gold trading below around 40, 47 on the way down, that cracked major support. That's going to the downside. We could see 3,900 and change. Silver's going lower. Everything is going lower right now. better to trade it and take advantage of it than not. The equity plays are super. See what's happening as well, why the chips are getting blasted. Asia needs energy, ladies and gentlemen. Without energy, they can't produce chips. That's why those stocks get blasted. See, once you know the relationships, you can play them. The crypto moves in Russia, they're passing laws. Big things are happening. Ladies and gentlemen, we're in the camp that Clarity Act is going to get passed. Use the volatility here if it makes sense to your own personal situation, that Gucci conviction, that Gucci clarity to accumulate while there's discounts here. There'll be no rain checks for XRP prices, baby, at these levels. There'll be no rain checks for ICB prices at this level. ICP, baby. Love that. XRP, I love it. I love it. I love the chaos. You got to be so excited about the chaos right here, right now, because of the price points it gives. Volatility is the long-term trader's friend, ladies and gentlemen. But again, if you want to take advantage of all this, the Crypto Public Desk monthly's portfolio was up triple digits the first 60 days of this conflict. The next 60 days would start right now because you got the Houthis and you got the naval blockade in Yemen. It's going to be spectacular. On one hand, I feel terrible that there's war, but on the other hand, it's financial mercenaries that we're dialed in and we're in carnivorous mode. For everyone here, again, we've gone back into carnivorous mode. If you want to enjoy gains, come and join the Crypto Public Desk monthly. One solid tip in the pits pays for your entire year subscription. We had a call at $71 crude oil. We closed that at 88. We had ranges for 95 and 93, but pigs get slaughtered, hogs get fatter. If you want to enjoy gains like this, because you're listening here every day, come and join the Crypto Public Desk monthly, ladies and gentlemen, because these trades allows you to stack your high racks of society higher. This is not financial advice, just my opinion, retains any capacity. But metals, once you got the relations dialed in, ladies and gentlemen, there you go. There you go. That's all you need to know. And knowing is half the battle, ladies and gentlemen. This, but at the end of the day, don't get cut up like sushi. Don't FOMO this. We're the remora for a reason. We swim underneath these things. We've been telling people that there was going to be the conflict was coming for a long period of time. All the family offices that retain any capacity are loving this. We sold gold and silver into the highs, and we have been waiting for this conflict to arise. The question you have to ask yourself this right now: do you want to learn to trade and invest and take advantage of this conflict and make very, very nice returns on a variety of financial instruments? That's up to you, ladies and gentlemen. I love you all. I'll see you on the front lines. This video is for educational information purposes only. This is not financial advice. Always consult your own licensed financial advisor for advice. Never invest any capital ever from watching a YouTube video. Don't ever invest money from watching any YouTube videos. Ever. Never, 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 never. I love you all, ladies and gentlemen. I'll see you on the front lines. Have a blessed evening.